And we talked to some investors also that have invested with operators that have, I'm doing air quotes, not experienced losses in the past couple of years. And one of the ways that you can do that as a real estate investor is think about how you're deploying leverage. So when you purchase real estate, typically you're going to put some equity down, you're going to work with a lender, and that lender is going to have certain provisions. You can get fixed rate notes, you can get variable rate notes. If you get a variable note, you can deploy rate caps on that, right? So you can ensure that if there are going to be increases in rates moving forward, you can protect against that. So you're essentially transferring risk of that rate cap increase from you to the bank, no different than the annuity investor transferring that risk of a market downturn from yourself to the insurance provider or the annuity provider. So that's one certain way to do that. Ty, as you know, if you do that, it's not free. There's going to be a cost involved if you deploy a strategy that ensures 100% of the time you're never going to have a fluctuation in your interest rate expense as it relates to your overall pro forma and your cash flow ability out of the fund.
Yeah, and we've done both. We've purchased rate caps on, and typically, what for listeners, you mentioned fixed rate loans and variable rate loans, and I've had our investors ask, why did you get a variable rate loan? Well, a property that has a value add aspect to it, where you are going to manipulate occupancy in order to renovate and implement CapEx to ultimately increase overall rent on a per unit basis, you're not going to qualify for long-term fixed rate debt. You're going to have to get bridge debt, and bridge debt comes with the downside is its variable rate. And so we've played both sides. We've done rate caps, we've done non-rate caps. We had a rate cap that ended up paying us, let's see, 18, 19x the value of the rate cap that we purchased. Purchased rate cap for $250,000. And I'm sorry, $125,000. And it paid us north of $2 million. We've also had a scenario where we paid a little over $1 million for a rate cap that didn't pay much of anything. We've had assets that we didn't get a rate cap on, and it chewed up every bit of the cash flow. And so, I think what we're looking at now with our newest fund, well, number one, we're the beneficiary of having access to capital. So secondly, it gives us opportunity. And so the opportunities that we're looking at are lenders that have put so much pressure on a borrower that doesn't have access to capital, and now borrowers willing to walk away, or borrowers willing to negotiate and have some sort of earnout built into a sell strategy. And so now our negotiation becomes with the lender. Lender has $20 million loan, they're willing to take a $15 million DPO. Well, we're getting $5 million of equity day one. And so, now with that strategy, I'm looking at using far less leverage and using more cash, which is another way to reduce risk on the front end. When you're acquiring assets at, 65, 70, 75 cents on the dollar, and then only getting 50% leverage on that, you're ultimately at 35 to 40% leverage on the value of the asset in totality. And so you've got far less risk. Now, what does that come with? Less return. That's part of that ebb and flow there. So as we look at that, let's look at the other side of the table now, the investors who are willing to accept risk. Why do you believe that side wins 80% of the time in shorter windows and basically always wins over a 10-year plus or minus playing field?